You know, every single investor, whether you're just starting out or you've been doing this for years, is basically walking the same tightrope. On one side, you've got this huge desire for growth, right? And on the other, there's that nagging fear of losing everything. So the big question is, how do you walk that line? How do you get the growth without taking a huge fall? Well, that's exactly the puzzle we're going to solve together today.
So, here's our game plan. We'll start by really nailing down that core dilemma every investor faces. Then, we're going to dive into a Nobel Prize-winning idea that honestly changed everything. After that, we'll get our hands dirty with the actual investment building blocks, check out some super simple tools anyone can use to diversify, and finally, we'll put it all together to build a portfolio that's truly resilient.
All right, let's kick things off with that universal conflict that's really at the heart of all investing. This constant tug of war between going for growth and playing it safe.
I mean, this is the million-dollar question, isn't it? We all want our money to work for us, to grow, to build something for the future. But nobody wants to wake up one day and see their hard-earned savings just vanish because the market took a nosedive. So how in the world do you get one without giving up the other?
For a long time, investors basically saw two separate roads. Over here on the left, you've got stocks. Think of them as the engine of your portfolio. They have this incredible, almost unlimited potential for growth, but that horsepower comes with a lot more risk. Then on the right, you've got bonds. They're like the shock absorbers. They give you stability and a steady income because you're essentially acting as a lender. The catch? Their growth potential is much lower. So the old thinking was, you had to pick a side. High risk for high reward.
But then, along came this completely revolutionary idea. An idea so powerful, it was actually called the only free lunch in finance. And believe me, it completely flipped the script on how we think about building a portfolio.
It's called Modern Portfolio Theory, or MPT for short. This whole concept was developed by an economist named Harry Markowitz, and it was so groundbreaking that it literally earned him a Nobel Prize. At its core, MPT is just a smarter way to build a portfolio, one that's designed to squeeze out the maximum possible return for whatever level of risk you're comfortable with. And here's the big mind shift. MPT says you have to stop looking at each investment all by itself. What really truly matters is how each one fits into the big picture, how it affects the entire portfolio. It's not about trying to pick a few individual superstars. It's about building a championship team where every player has a role.
So what's the secret sauce? It's all about combining assets that have a low or even negative correlation. Now, correlation is just a fancy way of saying how two things move in relation to each other. Think about it. When stocks zig, bonds often zag. So, by owning both, a drop in one area can be cushioned by stability or maybe even a gain in the other. This smooths out the overall choppiness of your portfolio. You get a much smoother ride without having to give up those long-term returns. And that, my friends, is the magic of diversification.
Okay, so how do we actually put this awesome theory into practice? Well, it all starts with having the right ingredients. To build a properly diversified portfolio, you need a good mix of these core asset classes. These are your fundamental building blocks.
First up, we've got stocks. To put it simply, when you buy a stock, you're buying a tiny piece of ownership in a company, making a bet on its future success.
And the role of stocks in your portfolio is crystal clear. They are the growth engine. They're what's going to drive that long-term appreciation, and in theory, their potential is unlimited. But all that high-octane power definitely comes with more volatility and a higher risk of loss.
Next up, bonds. Now with a bond, you're not an owner, you're a lender. You're loaning your money to a government or a company for a set amount of time, and in return, they give you regular interest payments and promise to pay you back in full at the end.
Because of how they're structured, bonds are like the defenders in your portfolio. They provide that steady, predictable stream of income with way less volatility than stocks. They are the crucial shock absorbers when the stock market gets turbulent.
And our third building block is commodities. Now we're talking about real, tangible, raw materials. You know, things like gold, oil, wheat, the basic stuff that fuels the global economy.
And these play a really unique role. Because their value is tied to actual physical goods, they can be a fantastic hedge against inflation. They also tend to dance to their own beat, moving pretty independently from stocks and bonds, which adds another really powerful layer of diversification to the mix. Okay, so we've got the theory down, we've got the building blocks. But how do you actually do this? I mean, you don't have to go out and individually buy hundreds of stocks, bonds, and barrels of oil. Thankfully, there are much easier tools out there that are available to absolutely everyone.
Let me introduce you to the index fund. This was a brilliant and brilliantly simple concept pioneered by Vanguard's John Bogle. The idea is, instead of trying to be a genius and pick winning stocks, an index fund just buys all the stocks in a particular market index, like the S&P 500. So with one single purchase, you can own a tiny slice of hundreds or even thousands of different companies. Boom! Instant diversification at an incredibly low cost.
And this one simple idea has totally transformed the world of finance. Just to give you a sense of scale, the U.S. index fund market is now worth over $16 trillion. So this isn't some niche fringe strategy. It's a fundamental change in how the world invests. And it's all because it made diversification easy and accessible for everyone.
And just look at what a huge difference that accessibility makes. Before index funds, if you wanted a highly diversified strategy, you might have looked at something like a private equity fund. But those were super exclusive, only for accredited investors, required millions of dollars to get in, and would lock up your money for more than a decade. Index funds completely changed the game. They're public, you can start with a very low minimum, and you can buy or sell them any day the market is open. They truly democratized what was once a very sophisticated way of investing.
So let's put all of these pieces together. We've talked about the core dilemma, we've learned the Nobel-winning theory, and we've seen the tools. Now, let's look at what the final product looks like, a truly resilient, modern portfolio. The ultimate goal here is to get your portfolio onto what economists call the efficient frontier. A good way to think of it is like the most optimal path up the mountain of investing. Any portfolio that's sitting below this line is just inefficient. It means it's taking on too much risk for the return it's getting. But by combining these different assets smartly, you can build a portfolio that sits right on that frontier, perfectly balanced to give you the highest possible return for the amount of risk you're willing to take. Your portfolio truly becomes stronger than the sum of its parts.
At the end of the day, building a modern portfolio isn't about chasing the hot new stock or trying to perfectly time the market. It's about thoughtful, deliberate construction. And that really just leaves us with one final question to think about. Is your portfolio just a random collection of stuff you bought? Or is it a truly resilient machine, one that's actually built to weather any economic storm that comes its way?